Hi everyone. I hope everybody is well today. We're going to go ahead and get started. This is Raising Capital, and this will be a pre-recorded webinar for you, and then we'll answer questions in the end. So look forward to hearing your questions, as this is a really important part of our business, and hopefully you have some good ones in the end. Here you go.
Hi, and thank you for joining us today for this presentation on Raising Capital Part 1 with a general focus on rules. Now, this is a three-part class. The first one going over the basics, which are the rules, a little bit into marketing. The second class is tiered towards financial literacy, giving you an understanding of what's going on with the market so you can engage people in those conversations. And the third class is actually on the presentation and follow up with credibility packet. There's three very important pieces to this. Is just the basics and understanding how to have the conversations and then how to follow it up with a presentation. So in part one, we're going to go over the basics and help you gain an understanding of what you can and can't do as it pertains to making an offering basically to private investors. So here's the rules. So many flippers take time and effort to comply with securities laws and make use of an exemption from the registration requirements under the Securities Act of 1933. Now, the guiding or superior entity that regulates this investment world is the Securities and Exchange Commission. And so they have these laws, and they do change annually. They do kind of make some changes that kind of guide us in what we can and can't do as far as asking people for money in this business. So the most common one is something called Reg D, or Regulation D. And it's the most often used as an exemption, at least by smaller companies, and all of us are at this point are at that level. And basically, when we ask for people for money and offering a return on investment, we're making an offering. It's not seen any other way. There's no other way to get around it unless we make a partnership with our investors. And it's generally under Rule 506. So it's 506 Reg D that basically requires the issuer who's offering securities, which we are, it's basically saying we can only do that to pre-existing contacts. So we can't advertise, we can't go out there and put it on Facebook, can't do a Craigslist ad saying I want to give 12% for someone's money to invest in my property or project. You cannot do those things. Now, here's the key. They have to be accredited investors. You see that at the bottom there. It says no advertising or widespread communication of the offering, and they have to be accredited investors. You might be asking yourself right now, what the heck is an accredited investor? So let's talk about that. There's basically two simple qualifications. It gets a little more complicated on the form, but in general, an individual income has to have income of $200,000 or more for 2 of the most recent years. So the last 2 years, they have to show a gross income of at least $200,000 if they're single. If they're married, that goes up to $300,000 for the 2 most recent years, and that's gross income. Or they have to have a net worth of $1 million. Now, that cannot, and I'm going to repeat that, that cannot be equity in their primary residence. So if they have a home worth $2 million and they have, they make $50,000 a year basically, they do not qualify. So, but if they own, a couple 4-unit buildings that are valued over $1 million, then that makes them an accredited investor, because they have, as long as they have at least that much equity. That means basically the SEC says, you know what, this isn't your mom and pop that don't know anything. They're savvy enough to go buy rental properties that have grown in value and created that $1 million net worth. Now, eventually this is going to go up, as we see prices of things increase with inflation, you're going to see that net worth number increase with it. So let's talk about friends and family. It's often the case that an entrepreneur's friends and family are not accredited, so if he limits his capital raise to accredited investors, the capital raise will go nowhere. So most people that are going to invest with you in the beginning are people you know. It's much harder when you don't have a track record to try to solicit money from people that you just don't know. So remember, the accredited investor rule is for solicitation, but not everybody kind of has what we call the rich uncle. So if you're a business owner in this situation, can you raise money from investors without those investors being accredited? The answer is yes, you can, but be very careful when you do that. Once again, can you pull money from people that aren't accredited? Yes, but be careful. This is a slippery slope. So there's some rules. And let me go back to that a little bit. You can solicit money from friends and family. And then there's this general question of when is somebody a friend? We'll get back to that in a little bit. So Rule 506 Reg D offers a number of ways in which you can accept investments from non-accredited investors. So under that rule, it allows a company, make sure you're a company, to include up to 35 non-accredited investors in its offering. It says, however, this is impractical for two reasons. First, any non-accredited investor must have such knowledge and experience in financial and business matters that he or she is capable of evaluating the merits and risk of the prospective investment. This is subjective, and unfortunately the only way to get a final determination if an investor meets this qualification is in the courtroom. So this is why you really want to be careful when it comes to soliciting money from unaccredited investors. If they're accredited, you're fine. You have nothing to worry about. Now they need to fill out a form to make sure they're a qualified accredited investor. They confirm that they have what they have. They sign off on it. And with that, basically they're promising you or telling you that they have what they say they have. They have the net worth. It's even better if you can get them to show you money in the bank or properties that you can see that they have the net worth that they say they do. But it's risky because when things go bad, and this is why I'm so conservative when it comes to these investments, because I know if they go bad, you're going to be on the hook and you can end up in a courtroom very quickly. So Rule 504 allows a company to raise up to $1 million. So there's two rules. There's 506 and there's 504. 504 allows you to raise up to $1 million over a 12-month period. And there's no requirement with that rule that the investors be accredited, as in the case, as you saw earlier, in Rule 506. So you just have to figure out, now this is a filing with the SEC if you're going to go one route or the other. The one major limitation placed on Rule 504, all right, is that there must be no general solicitation. You cannot market. So that is, well, how do you get investors without marketing? That's kind of the interesting question. So all investors must be pre-existing contacts of the issuer and its principals, and no advertising or widespread promotion of the offering is permitted. All right, so basically to me, this means you can raise $1 million from your friends and family or pre-existing contacts. That's what it means, and that's going to be subjective. They know people have to raise capital to start business. They know not everybody is going to get a loan from the bank without a proven track record. They just want you to be careful. They don't want you to hurt somebody, and that's why these rules are in place. So let's get back to the friends and family. So loans from family and friends make up probably one of the largest strategies that new investors make. And I want you to know the SEC has no rules governing this way of raising funds. When your family member decides to invest with you, it doesn't matter if they're 18 or 80, whether they're accredited or non-accredited, a family member has the right to invest in you because you're family. Same with friends. Now, however, if the money is given without a promissory note, and that's one thing I want you to remember is the word promissory note, or any interest charge, the IRS will look at it as a gift. So if you take money from family, you have to write up what we call a promissory note, or a promise to pay back, and an interest rate charge. And the interest just has to be fair. It can be 2-3% in this market and be completely fair. Without that, it ends up being a gift, and then there's some taxable consequences for that. Here's the magic. This is kind of the magic to someone being your friend. Remember this. A person becomes your friend after you've met with them or had communication with them at least 3 times. Has to be 3 separate times, okay, without discussing the investment that you would like them to invest in. So you can talk about real estate, you can talk about their hobbies, you can talk about anything with these people, but if you say, Mr. Investor, I know we're becoming friends, I have this property on 123 Main Street and I would love for you to invest with me and I can offer you 12%, you've broken the rules and you can be held liable for that if things don't work out. Here's another one that happens. You befriend somebody. You befriend one of your friends, Aunt Sally, and Aunt Sally is 70 years old, and she's not your aunt, she's your friend's aunt, and she has this huge retirement fund. And Aunt Sally says, you know what, I will invest with you. And then what happens is she happens to have a son who's a financial planner who happens to know these rules, and he says, hey Mom, do you have, I'm in financial planning, I'd love for you to invest in this new annuity that I have. And she says, oh no son, I invested with this person over here and I'm investing in his real estate investment project. He starts to ask questions, he realizes that you've broken the rules, and then he can call the SEC and have you basically have a cease and desist on the project, and then it just goes bad from there. I've seen this happen personally, and I've seen someone shut down for a couple years while they were trying to figure out how to do things the correct way. So you just have to be careful. You have to ask the right questions. You got to go through the process. Now, if there was an interaction 3 different times, then you could prove it. And that's why I love cell phones, because normally we're texting, we're emailing, and it's usually in one place. So we can prove that we've had conversations. There's a phone call log. It usually shows how long you spoke. So if you can prove 3 separate times, and I'd probably make it 4 or 5 without discussing the investment, you're safe. So just know that. That person now can be, they can be called your friend. Hey, get out. All right. So here we get into the nitty-gritty a little bit. So you're going to want to structure it as a debt and record a first position deed of trust. Remember earlier we said there was a promissory note? There's also something called a deed of trust, which secures someone's interest in a property. If somebody is a gap, let's say you need $500,000, and you don't know anybody with $500,000, but you do know Aunt Sally has $200,000 sitting in her bank account and it's not doing anything for her. And now you've befriended your buddy's Aunt Sally. You're going to get a hard money loan for the first portion of that, which is generally 80% of the purchase price. All right, you bought the house, maybe you bought it for $500,000. You can get a loan for $4. You need another $100,000 for rehab. So what you can do is you can get a hard money loan, and the hard money lender is going to want to be in a first position. And then you basically call your buddy's Aunt Sally and say, I have this great investment. I can offer you a return on investment that's double digits, but I'm going to put you in a second position. Are you okay with that? So you can determine which position depending on how much money they have. All right. So if you look at this, you put them in a first position if possible, second. Theoretically, in our business, you're safe even in a third if you have enough margin. Where you get in trouble is if you make a risky investment, there's not enough margin and it goes bad. You can really end up in a lot of trouble doing it that way. So my advice would always be conservative, follow our general rules, do not break them because you don't want to lose somebody else's money. All right, so if you don't pay them back, they can foreclose on the property and own it themselves. Matter of fact, if you've rehabbed this and you don't start paying them back, they get a property now worth way more than when they invested with you. And it could actually be a great thing. Now the scary part is if you didn't rehab the house and you didn't improve it and you took that money, that's where the danger starts. So you're going to pay them interest on their loan, and when you sell the property, they get paid off via escrow. Now they get paid as long as they record this thing called this deed of trust. So there's two documents, and we're going to show this in a minute, but there's a promissory note and a deed of trust. The promise is the promise to pay. The deed of trust is what gets recorded with the county recorder's office. These two documents are very important in that they protect your private investor. So how much you pay them is between you and the investor. Now we've seen arrangements anywhere from 6% all the way up to 15% interest, which is generally a hard money rate. I've seen people charge as much as 10 points. I think that's ridiculous. So what that would mean is the Aunt Sally says, yes, I'll loan you the money, but you're still new at this. I'm going to charge you 10 points on my $200,000. That means she's going to charge $20,000 or 20%. Basically, she's charging 1% 10 times. So 1% of 200,000 is 2,000. 2 times the 10 would be 20 grand just to do business with me. That wouldn't have anything to do with the amount of interest I'm paying her. But if you couldn't find money, maybe that's your only resource and the deal makes sense, maybe you do that. Now there's some rules on the other side as well that protect us from getting kind of scammed as well. So there's this thing called usury law, and what that says is that somebody is in the state of California is only allowed to charge you a 10% interest rate unless they are licensed or NML licensed or a broker in the state of California. So it's still the same. The last I checked it was 10%. So really Aunt Sally would be breaking the rules if she started trying to charge me more than the 10% if she didn't run this through a broker. So one of the easy ways to do this, let's say that you are kind of new. Obviously here you have the help from Fortune Weaver staff. But breaking into the business, if you need to raise capital, a title company can help you with preparing all of the documents, the note, that promissory note, and the deed of trust. Also a real estate attorney can do it, but they're going to charge you a hefty penny. Title company just wants you to make sure that you use them for the title when you go to sell the property. So if one of your investors doesn't have enough money to do the deal by themselves, you can engage a private money broker with the proper licenses to arrange for 2 or more investors to do what we call a fractionalized note. Now a fractionalized note, try to remember that term, a fractionalized note allows for 3 different investors with smaller amounts of money to actually be recorded in a first position. So you could actually get up to, let's say you have 10 investors with, 50 grand. That meets your $500,000 criteria on the project. You could record all of those people with a fractionalized note into a first position. Now, one of my favorite ways of doing business is with what we call a joint venture agreement or a JV agreement. They basically allow you to partner with your investor and determine who plays a role based on the skill they bring to the table. So what we generally do with a joint venture partner is they are, according to the joint venture agreement, they are to be a passive, their skill is that they bring the money, so they play a passive role in the investment. They're not here to choose colors, help with construction, or anything like that. They're there to be just that, a passive investor, because the skill they brought was their money. The skill we bring is the ability to find the deal, flip it with our contractors at our pricing, and get it sold for the highest amount. So that's a second skill. So a joint venture agreement is really important in that process. And if you partner with someone in business, now they don't have to be an accredited investor because you guys are partnering together. You're going into business together. It's much different than soliciting someone just for their money. And I would say that this is the safest way to bring in an investor. So as we mentioned earlier, there's two documents that are very important. These are the most crucial. One is the promissory note. A promissory note is a promise to pay at a specific amount of money back at a particular interest rate in an amount of time that's defined in the promissory note. So most of ours go 12 months because we used to do it shorter and then things would go long and our investors would cry foul or ask for more money. Generally, we write them for 12 months with an additional 30 days in the event that the property hasn't sold. We generally pay our investors usually 12% annualized, which means if we borrow $100,000, the payment at the end of the project is $1,000 for each month we use their money. So let me give you an example. Let's say I buy a house and the total amount of money I borrow from a private investor is $500,000. And that project goes 4 months. And I promise to pay them 12% annualized. All right, so it's really easy when you pay 12% because all you do is take 1% for each month. So if I borrow $500,000, 1% of that is $5,000. That is the monthly payment I'm paying for that money. So if it goes 4 months, it's 4 times 5, or $20,000 for using the money for that period of time. If it goes 6 months, obviously I'm going to use 5 times 6, which is $30,000 for using their money. That would be considered my holding cost when it comes to borrowing money. Now, a lot of newer investors will do a promissory note. They figure that part out. But the promissory note is just a promise to pay. It can be on a napkin. It's not generally notarized, and it's not recorded. It is the piece of paper that you hand to someone that they hand back once they get paid. The second most important document when borrowing money is what's called a deed of trust. A deed of trust secures the principal and forms a lien against the real property that you are investing in. So if I invest in 123 Main Street and I record a $500,000 deed of trust, that states that that person has a $500,000 interest in that particular property. And I cannot sell it without that person getting paid back. Now their term, once they invest the money, they are called a beneficiary. The beneficiary is the first to get paid according to the order in which liens were recorded against that property. So, for example, if there was Bank of America in a first, Jim in a second, Ted in a third, each of those entities would get paid through escrow on the sale of that property in the order of which their promissory, or their deed of trust, was recorded. Now, a lot of us are doing business in Los Angeles, and when we invest in a property, what we do is we record the deed of trust, not the promissory note. We record the deed of trust in the county in which we are doing business. So obviously if I'm in Los Angeles, I would go down to Norwalk, the county recorder's office, and I would record the deed of trust there. It's generally a $50 charge to do that, so you have to keep that in mind. The promissory note stays with the investor. They're protected, and then when the property closes, that investor gets paid back, and there's what's called a reconveyance. So they get reconveyed their investment. For in Orange County, we would go down to Santa Ana to the county recorder's office there. But basically, any county you're in where you're borrowing money or doing business, that's the county recorder's office you go to record the deed of trust. So we want to move a little bit into marketing. So one of the easiest ways, people ask me all the time, well, I don't know anybody with money, and I don't know how to have those conversations. Well, our next class will help you with that, because you're going to learn a little bit about what's going on with the economy. You're going to learn a little bit about Rule of 72 and how to have a really neat conversation with someone to get them to at least sit down with you. But one of the best ways to do this is to go to a networking event. So you want to find, there are investment club meetings almost every day of the week, every week, all over Southern California. There's tons of them. And a lot of people that have money that are fed up with the stock market will go to these meetings because they want to invest in real estate. They just don't know how. They know they want to be private investors. They know there's great returns. They've read it up on Google. They understand how to protect themselves. They go to these meetings, and some of them want to be flippers. They just have no idea what they're doing. So you can go to these events and figure that part out. So here's the criteria. The first, you want to make sure they're brand new. Because if they're not, they're already spoken for. They're already in someone else's hip pocket. So that you want someone who's brand new, and there's a ton of them that go to these meetings. And second, you want to make sure they have money. It's just the way, that's what you're looking for. So here's the scenario. You meet someone you don't know at the event, you walk up to them and you introduce yourself, and you ask them their name. All right? Hello, my name is Donna with Fortune Weavers. If it's me, hi, my name is Sam with Fortune Weavers. What's your name? Okay, then as you're having a conversation, you want to know what their experience level is, and you just say, well, if you don't mind me asking, how many deals have you done? Oh, I haven't done any deals. Or, oh, you know what, I sold a house, 3 years ago, and I had lived in it a couple of years. Well, that's not a flipper. We all know that. But a lot of people will use that to say that they flip properties. So you want to ask how long they've been in the business, and ask them what their goals are. How many flips are you looking to do this year? A lot of them will say things like 5 to 10 because they just don't know. But you want to ask them what their goals are for this year. So how many deals are you planning to do this coming year? And how much they're looking to spend on the deal. This is the key thing. So if they've done their homework, so let's say they say, oh, I'd like to spend $700,000. Your light bulb should go on. If they say, I just want to spend $100 or $100,000, you start to question that a little bit. Right? What price points are you looking to buy? $400,000 or $700,000? You can ask questions like that. And find out if they have money and how much. So here's what you do. Right? So if they say, I'm going to do 4 deals this year, you say, 4 deals, huh? So if I brought you a deal that made sense, how would you finance it? Now this is the secret sauce to this whole thing. If I brought you a deal, if I found you one that made sense, how would you fund it? Or how would you finance it? If they say their own money, bingo, they have money. If they say, I don't know, move on, find someone else in the group to make friends with. Obviously, don't be rude about it, but you're there to find money. So this is the process. I've done this several times. I would say a few of our investors are actually people I met at networking events. I have one who's invested $400,000 with me, and it came from one of these events. And you got to figure out what's in it for them. Are you going to joint venture with them? All right, that's awesome. I've been in the business for a while now, and I've built up a pretty solid team. Collect contact information and find out something that you can talk about at lunch with them to build rapport. You got to be real careful now because you're on that line of solicitation. So befriend them. Make sure you email them, you text them, you call them. Make sure you pass the friend rule, which is the 3 contacts, 3 different contacts, 3 separate, without talking about what you're actually going to work on together. Get their business card, all right? And if they don't, obviously we have cell phones now, you'd probably just get their phone number. You know, sometimes people have blank note cards and just write it down on that. By the way, what's your favorite sport? Who's your team? You want to have the small talk. And again, now you want to go move on to the next person and do exactly the same thing. And get as many business cards of people that are new and using their money as you can, because now these are your prospects. And I know this might sound cheesy, but this works. All right, so when you meet somebody, there's something we call form. All right, we want to form people. So family, we want to talk about family. We want to take and jot notes in our mind about what they say. This is part of building rapport. An easy thing to talk about is what they do for a living. Most people that are brand new aren't full-time real estate investors. They have a separate job. So what do? Recreation. What do they do for fun? You know, do they play sports? Do they go hiking? You know, do they sit in front and play video games? What do they do for fun? So that's the recreation part. And M stands for money. It can also stand for your message. So, but money is really what you're looking for. So at some point you need to have a conversation about it. One of my favorite techniques is called the feel, felt, found technique. So when someone says to me, you know, I would love to invest in real estate, but my uncle Rodney got screwed over, and, you know, I just don't think I could do it. You know what? I know how you feel. I felt the same way too when I broke into real estate investing, because there's a lot of sharks out there. But you know what I found? If you do your due diligence on people and you check them out and you see that they're legit, you can actually make a lot of money investing in real estate. So that's called the feel, felt, found technique. I know how you feel. I felt the same way too, but this is what I found. And so it's just kind of a way to overcome that objection. All right, for homework, I would like for you, all right, those of you on this video or this webinar, I want you to email or text me that you're ready for your homework on Raising Capital Part 1. And what I will do is I will send you a template of a promissory note and deed of trust. These are very important documents in raising capital. I didn't want to overwhelm you with too many things tonight. And so what I want to do is I want you to see those documents, and I would like for you to write up a promissory note for $100,000 that's promising me, Sam Weaver, that you're going to pay me back at a rate of 12% annualized. All right, so let's just say that's your gap money, right? So you're going to take this template and you're going to write it out the best you can, and then you're going to send it to me. I'd like to see what you come up with. We're going to do a deed of trust the same, and basically I have a video on how to do this, but I'd like to see how you do it on your own first go around. And then over the next couple of weeks, we have the 4th of July. There's a lot of families getting together. And then what we can do is have you talk to someone about investing, especially a family member or a friend, into investing in your next project, or partnering with you on your next deal. So, you know, say something like, how would you like to make, you know, double-digit returns or something like that. All right, and that's it. We'll open this up for questions, and I will talk to you shortly.
All right, let me see if I can do some Q&A here. So if you go to the Q&A mode, you can ask questions, and I will answer them in the area where it has that Q&A. So go ahead and push on that. You can type a question, and we'll go from there. And before we move forward, I actually thought when I was playing a video that my mic was muted, and I am at home, and there was some controversy between the kids. So I apologize for that. The dog was barking. I was notified by someone that that was taking place, so that will not happen again. Yeah, I'm sure you have lots of questions. This is a very important part of the business, raising capital. And if you have one, I'm going to go ahead and leave this line open. It looks like someone's asking right now. What was step 6 of finding a private lender prospect? Step 6, I believe, was where you are basically building rapport with that investor. So basically, step 6 is you've befriended them, you're exchanging information, and you are going to make sure that you schedule a follow-up meeting with them. But just make sure that you absolutely do not talk about the investment you may have on your plate that you need them to invest in. You can't do that. So you got to wait. If you want to go ahead and unmute yourself, Alejandro, you can ask that question. Hopefully I answered that. All right. Any other questions? All right. So I just want to expand on this. Well, here's Lynn and Leo. Hold on. If I go to a meetup and there was a person who was actively seeking to be an investor, do the rules still apply where you have the 3 contacts with them before talking about actual investments? All right. I would say yes, but if you find out they're an accredited investor, I think that goes out the window. The 3 contacts is for us to determine whether someone's a friend. If you find out somehow through your questioning that they're an accredited investor, that would eliminate the need for the 3 contacts. Probably not going to happen on your first meeting. I don't think usually people with a lot of money don't brag about it. And the people that are bragging about it really generally don't have it. So if they're an accredited investor, you don't need to worry about it. If they are not, they need to be your friend, and you need 3 separate contacts no matter where you meet them. I'm not sure you guys were able to hear me. I'm still trying to figure this part out. Hopefully that answered that. Any more questions? All right. While I'm waiting for questions, I want you to be thinking about asking this magic question. This kind of takes you out of the equation a little bit. If you could share with people and say this, if I could introduce you to someone that I know and I trust who could offer you double-digit returns on your money and it was secured, would you be interested in finding out more about it? Let me repeat that. If I could introduce you to somebody I trust who could offer you double-digit returns on your money and it was secured, would you be interested in hearing more about it? Matter of fact, this person comes highly recommended and has tons of references that they could share with you. Alex, if you email me, I'll send you a copy of the presentation in PowerPoint PDF, and you can get that answered. So once again, just email me, sam@fortuneweavers.com, and I'll go ahead and send that back to you. Okay, so David asks, I have one. I'm writing it now. My LinkedIn page says real estate investors specializing in high yield flips for cash by partnering with select private investors. I would say that's on the line. The SEC may make you take that down, but I would say you're probably okay with that. You're not giving a specific return on investment. You're not saying 12%, 10%. you're just saying, hey, I'm looking for partners, you're probably okay with that one. The SEC might feel different, but I think you're okay. All right. All right, so I got another question. When you say secure, it's because of the contracts. When we say secure, it's because we're recording a deed of trust, which secures the person's principal in the property. So as long as we record that deed of trust, and sometimes we can either hire an attorney or we can hand it to them to record, or we can record it ourselves. There's only really 3 people that can do it: an attorney, the person, or us. When we record the deed of trust, that secures their money, and that property cannot be sold without them being paid back first. The only time there would be a major issue is if the market completely crashed and they were in a junior position and it got foreclosed on. There's a slight chance that they could lose their investment in that case. All right, any more questions? These are some great questions, guys. Once again, the next class is going to be on financial literacy. It's really important to pay attention to that because it gears you up to have the right kind of conversations to involve people in, to get them to talk about money. Money is taboo. People hold on to it. They don't like talking about it. So if you can engage people in the right kind of conversations, they tend to open up. And that's when you ask that mystery question, hey, how's your investments doing? And if I could show you someone, or if I could introduce you to someone that's offering double-digit returns that are proven, and he comes highly recommended, and I trust, would you be interested in sitting down with that person? Now, here's the reality of it is sometimes we have to do a phone call. Sometimes it's in person. Usually these people are not happy, right? So they're frustrated with their current situation, and so that's when they tend to want to look elsewhere. The stock market's done really well for people, and so it's one of those things where it used to be people were really dissatisfied after the crash, and now we're starting to see where people are okay with the stock market again. All right. Rosa says, can you repeat the part where people could lose their money? Okay, so let's say someone's invested with us. They're in a junior position, not a first. They're probably in a second or third. And we have a 2008. And, we can't sell the property. And the property, the first, which would be the hard money lender, they foreclose on the property. There's a slight chance that property doesn't have the equity, which would be really hard if we bought the property right and we followed the rules, but there is a slight chance that the second wouldn't get all of their money back through the foreclosure. Now, that doesn't mean that they wouldn't sue one of us for the shortage, because they absolutely would, but that just means through the foreclosure, that second might get wiped out. Now, the chances of that are really slim if we follow the rules, and this is why I'm such a stickler with following our formula, because I've seen it happen. I've seen other people make and take the risk, and they've just lost. So we don't want to do that. Hopefully that helps. I also want to comment on the fact that our investors have never lost money. Our investors have, we've been doing this a long time, and it's because we follow the rules. Now, there's some times where we take hits, but this is why, especially in a market like this, we want to be smart. We want to make sure we're making really good decisions with other people's money. All right, and I got a hand raised here. Let's see. All right, it looks like it went back down. And I think, Denisha, if you had a question, if you could do it in the Q&A. All right, Alejandro, I see you raising your hand. Alejandro, if you could go to and ask the question in the Q&A, that would really help me. All right, I'm going to promote you to panelist. You can actually ask a question. All right, Alejandro, can you hear me? You need to take your, you have to unmute yourself. Okay, you're unmuted. What was the question?
I wanted to know more about if you could introduce us as someone that you trust, if we'd be interested, when would that take place?
Well, in that situation, you're not actually soliciting someone to invest in your project. I'm going to do that for you. So what you're going to do, this is with someone you may know, you're comfortable with already. And so what you're going to do is, so let's say I'm talking to you, Alejandro, and I say, hey, Alejandro, you were just telling me that you're not real happy with your returns on your CD in the bank. You know, you said they're only giving you like 1%. Is that right?
Yeah.
Okay. So Alejandro, I happen to know someone that I trust that's doing great things for people. If I could introduce you to someone that is offering double-digit returns that are secured and I trust them and they have tons of references, would you be interested in hearing more about that?
Okay, I got it.
Yeah, and you just shut up, right? You can't just keep talking because then you throw up all over somebody. You just got to stop, let them respond, and they'll tell you yes or no. If they say no, respect it. And then you might say, well, I don't want to hear about your horrible returns in your CD because this guy's doing wonderful things for people, right? And, you know, inflation is 3%, you know, so if you're not earning more than that, you're actually working backwards. So you have to be bold sometimes and say stuff that you're not comfortable with, but people, it will resonate with someone and they may not say it right then and there, but they'll call you back and go, hey, who was that person? And another way to do it is to say, so Alejandro, say you and I are having the conversation and I know you, and you just complained about your CD, right? You're just like, yeah, I'm not real happy with my, you know, I got to figure out a place to invest my money. And I basically skip over you. I say, hey, Alejandro, can you hear me?
Yes.
Okay. I just want to make sure we're having a two-way conversation here. All right. So I say, hey, Alejandro, if you know anybody that is looking to invest their money and earn double-digit returns, could you pass on this message for me? I happen to know someone that I trust that's getting people double-digit returns that are secured and has been doing it a long time. They have tons of references. Would you be willing to share that with some other people for me to see if they'd be interested? Because I know there's some good projects coming up. So basically, you skip over them, and when you do that, it's kind of like a takeaway. And they go, well, wait a second, I just told you I wasn't happy with my money. What are you talking about? And you might go, oh, well, I thought your money was in a CD. You know, a lot of times CDs are locked up. Oh, I'll take my money out, right? And that's kind of how that works.
Okay.
All right. I'm going to move you back to your normal place here. All right. Thanks, Alejandro. Give me a second. I know there's some other people. All right, Denisha, is there a minimum to invest with Fortune Weavers, at least 50 grand? All right, so the question is there a minimum? You know, I'd probably like to think that it's like 25. Now, we can use $10,000 for earnest money deposits. And on an earnest money deposit where we're wholesaling, I like to offer someone $500 or 5% on their money for putting it up for us to, because there's a little bit of risk. We've only lost a deposit one time out of all these years, but I like to offer a nice $500 fee for letting us borrow 10 grand for 2 weeks. So there's a minimum. That would be something that would work there, but usually 25,000 is kind of a minimum, especially for a price lift. Those work well for price lifts. If someone has 15, you know, we'll talk about it. We just want to make sure they're one of your friends. Great questions, by the way. And remember, they're not really going to invest with Fortune Weavers. I'm going to circle them around to invest with you. I just want to make sure I'm a part of those projects so I can make sure their money's safe. All right. So I can't just talk about how great we are and then send the money to you individually on your own project. So we'd have to be a part of that. And then after year 2, we would say, hey, we don't take your money. You need to invest with Denisha on the next one. She's ready and she has us for support anyway. Any other questions? All right. So I'm going to highly emphasize that you start raising capital. We have a ton of people finding projects all of a sudden. And, it's nice to think that Fortune Weavers is going to fund all those. Now, if we fund them, you don't make as much money. So understand that. You make a lot less if we have to fund your project, because it's not fair for us to consult, right, and then have to fund something with our investors, because we could be using that money for our own projects. So, it's one of those things where I want you to step up, really try to raise capital. At least if you show me an effort that you're trying, it means that I'll probably want to invest more in a project that you bring if you aren't successful in raising that capital. But if you put me in front of people, there's people on this call that have, and if they found something, I love the fact that they've at least tried. That shows me that effort. And of course, I'm going to try to invest in their project. All right, we've got another question here. Okay, so what can you tell the possible investor if he is scared of Uncle Sam? The Uncle Sam is not going away. And we pay investors interest on their money, which is considered income. It's ordinary income. Its income is earned. It's on top of what they make now. The only way around that would be to sell shares of the company to investors. We just don't do that. And so it's ordinary income. They're making double-digit returns. They probably shouldn't complain. If they want to use a self-directed IRA, or if they want to use their life insurance to invest with us, which is, if you know someone with whole life insurance, they can borrow from it and invest with us and get a return. It's one of the great ways of arbitrage. Or to take a zero-interest credit card, invest with us. I have an investor that he invests $25,000, $30,000 on zero-interest credit cards every year, takes the money we pay him and uses it for a vacation for his family, and doesn't, he pays back his credit card, he pays back the fees, and he still has enough money to do that. So you just got to understand that there's a price to pay for getting double-digit returns. And those investing in price lifts are generally getting a 10% flat fee. So if they invest $2,500 or $25,000, they're getting $2,500 in a short period of time, and they can do that twice and earn $5,000 on their $25,000. That's unheard of. That's like a 20%. Well, it is a 20% return. So, I don't see where anybody else can do that for people. Good questions. Really, raising money is about getting someone in a conversation. And the next time we have a class, it's going to be on the Rule of 72. When I teach you how do you do the Rule of 72, matter of fact, it's something you can do on a napkin. It's been one of the most powerful things I've done to raise capital for people. If you don't know what it is, you can Google it, and maybe you'll get a head start on what I'm going to teach you. But it's one of my favorite ways to get people to invest. Because what you do is you compare what they're getting right now to what they will get with us. It's a no-brainer. All right. I'm not seeing any more questions come up. So we're going to go ahead and call this a night. And I just want you to know there's no class next week. We'll be coming out with a calendar here over the next day. No class next week. We're going to take the week off for the 4th of July, and we're going to enjoy our time with our families. And so just know the 4th is next Tuesday, so there won't be anything Tuesday, and I will be taking the rest of the week to make more videos and create some more content for you guys. All right. With that, you guys have a wonderful evening, and I will catch up with you later.